I'm Eric Lipsy, and this is Golf. Today, I'm here with Luke Carter, financial advisor with Mass Mutual. How are you doing today, Luke?
I'm doing well, Eric. Thank you for having me on. I'm really looking forward to our conversation and interview today.
Outstanding. Okay, well, today we're here to talk about life insurance, and I'll let you get started with maybe talking about term.
Yeah, today I want to talk about a component of estate planning, specifically life insurance. And
Okay.
I think this conversation today will really pair well with an earlier interview you did in October with Lou Leak around wills and trusts, because it all falls under that estate planning umbrella.
Yeah.
I know life insurance can be a tough topic to even think about, yet alone discuss. And everyone hates that life insurance in the room every meeting or every networking event. But I think it's such a crucial part of financial planning and estate planning that it's really too valuable not to have a conversation around and do some planning around.
Mhm.
Now, most people own life insurance, whether it's through their employer or have an individual policy, but most people actually don't understand exactly what they own. And my goal today is to help educate you and the viewers around the different types of life insurance, and specifically how high net worth individuals and families view it and use it as an asset class.
Okay.
Sound good?
Yeah, sounds great.
Perfect. So I want to start off by really distinguishing between the two most common types of life insurance: term and permanent insurance. So now term insurance provides a guaranteed death benefit for a specific period of time. So usually, we see 10 years, 15 years, 20 years, and that means that you're paying in a fixed premium, and if you pass away during that time frame, your benefit or pays out to your beneficiary or family tax free, which
Mhm.
is great. So I like to think about it as kind of renting a home, where you essentially don't own the home, but you still have possession of it. And that's essentially what a term insurance policy is. And now the thing is, term insurance is usually the best option for people in most cases. So why is that? It's cheap and affordable. Term rates have been dropping for 30 years right now. So it's really cheap and affordable, fits in most people's budgets. Insurance companies have made it very easy to apply and to get approved on these policies, a lot easier than what it used to be. And one of the best parts, as I said before, is your beneficiary and family gets that entire death benefit tax free to help provide for liquidity, help pay for interest, debt, expenses, whatever it may be. And it allows them to continue to live on their life, not have to reduce their lifestyle just because one of their loved ones is out of the picture.
Okay.
And a great feature within these term policies is a convertibility option, which allows me, within that time frame we were talking about, to convert my term insurance into a permanent insurance policy, in which it kind of goes from renting to owning a home. So
Mm.
now I'm able to build up equity inside of this policy and use it over a longer time period, my whole life, which is great.
Gotcha. Now, okay, so for me, my term insurance policy was a 20 years, so it,
Yeah.
it matures, or not, doesn't mature, I guess I should say it expires basically in
Yep.
8 years from now. So what does that process look like? Because I was just under the impression I had to go get another term
Yep.
insurance policy. So what does that process look like from going from that term to that more permanent insurance?
So really, with 8 years left, that means that you've been paying for 20 years of fixed premium per month annually.
Mhm.
At the end of that 20 years, that price is really going to skyrocket. So
Yeah.
it really doesn't make any sense to hold on to it. So what we see mostly is either people drop their term policy and just buy more term coverage. It's
Mhm.
more affordable, or before that 20-year term period ends, they convert that into a permanent insurance policy, which
Okay.
is nice because I don't have to provide more insurability because I can convert that, so I don't have to go through more medicals or provide more health history. But the issue with that is you are paying more, because it's essentially going from renting a home to owning a home. So my mortgage payments are more expensive, but it does allow me to build up equity inside of that policy that I can borrow or loan against down the line if I please.
Now, would a permanent policy be more in alignment with like a whole life or universal life, or is that what the permanent is, or is that something different?
Yeah, so permanent policies, what falls under that is really three general types of categories. So whole life insurance, which
Okay,
is really most common, a variable life insurance policy, and a universal life insurance policy.
gotcha.
So really, it gives you optionality to be able to convert into one of those policies down the line within that time frame.
Okay. Now
And I
maybe
just,
you can break down some of those for us too, just so we understand, because I know those different policies have different stipulations, different requirements, different costs.
yeah, different features. And I just wanted, before we kind of dive into the permanent,
Sure,
just
yeah,
give you and the viewers a sense of kind of how cheap term policies are right now. So just
okay.
for a simple quote, a 30-year-old for a 20-year period similar to yours,
Mhm.
for 500,000, half a million is $49 a month for a male,
Wow.
$41 a month for a female. So
Hmm.
what does that mean? That essentially means that you are able to put a large insurance company, AAA rating, AA rating, on the hook for 20 years for $500,000. And
Yes.
that's why term insurance is such a powerful estate planning tool, because it's so affordable, but for the benefit that it pays out for loved ones, families is very powerful, and it can make a very large impact on a financial plan.
Absolutely. I really like that you brought that up because a lot of people, I'm guessing they think life insurance is so expensive because you see so many people, not judging anyone,
Yeah,
but
yeah,
you'll see people out raising money after someone passed away.
yeah, yeah,
They're out trying to raise money for their burial costs and, the funeral arrangement, that sort of thing. But then you look at the cost per month for insurance, and I don't know, maybe it's just a thing where when we're younger, we think we're inevitable. I mean,
yeah,
we're invincible in that we're not going to die. Like this is something that happens to other people. It can't happen to me. And
yeah.
I don't know if that's the mindset why people don't just do it because, like you said, it's a very affordable
Mhm.
price, and then you have all of this benefit that you can leave for your family in the event that you are no longer with us. So it's just really interesting that people don't move on that sort of thing.
Yeah, it plays such an important part on the protection piece in someone's financial plan. As we were saying earlier, as people think we're inevitable, and I've had personal scenarios, even within my own family, where that's not the case. People think we're a lot healthier than we are until an unfortunate event kind of changes our perception in life.
Hmm.
And I think it's just such an important protection piece and so affordable now that it should be shouldn't even really be having a conversation around it.
Yeah,
That it
and like
should
you
be,
said, you're locking up that price for 20
yeah,
years.
yeah,
So it's not like you're going to come to you next month and ask you for twice the amount.
yeah.
That's your set rate for 20 years.
Yeah, so that's why I want to get back to my point. For most individuals, term insurance is the best option.
Hmm.
But now I want to switch to that permanent side that we were talking about. And under the permanent insurance really falls three categories: whole life insurance, variable life insurance, and universal life insurance.
Okay.
Now, for higher net worth individuals facing a large estate tax issue or wealth transfer planning, permanent insurance is what they need to help provide liquidity at death to help pay for some of those estate taxes.
Mhm.
So, permanent insurance has been around for many, many years. It's not like this came out just within the last 5, 10 years. And it can be a very powerful tax, retirement, and estate planning tool. And I just want to take this time right now to show you and the viewers
Yeah,
why that is and why wealthy individuals and families view it as an asset class.
okay, let's do
So
it.
I'm going to pull up a quick whiteboard. I won't get too crazy, but I just think it's easier to articulate and get these points across. And as I said earlier, this is actually how this is viewed and how this is shown to high net worth individuals.
Okay.
So Eric, say we're talking, and I want you and the viewers just to get the word life insurance out of your head, right? Because there's so many perceptions. What I found is not a lot of people exactly know how permanent insurance works.
Mhm.
So let's get life insurance out of here. I'd say I came to you as a friend, or better yet, a financial advisor, and said, Eric, I found this great new product based on your net worth, time horizon, risk capacity, goals. I think could be a very good fit for you and your family. Would you not least be opening to having a conversation, maybe learning a bit more about it?
Absolutely, I'm open to
Yeah. So what if I said, to start off, what if I said, so this product or investment is invested in multiple different asset classes broken down over different time horizons. So it's
Mhm.
essentially a well-diversified portfolio with the biggest allocation being in bonds, so fixed income, private and public bonds, There's an equity portion, there's a mortgage portion, a real estate portion, all invested in different asset classes. So, starting off, it's a well-diversified product. Sounds pretty good.
Yeah.
What if the next thing I told you is that the companies that sell these products, insurance companies, are some of the largest, oldest financial institutions in the US. So, a lot of these large financial institutions are very high rated. So, AAA rated, AA rated, very safe. The company I work for, Mass Mutual, is over 170 years old. So it's not like they've been doing this for 20 years. These are some of the largest, oldest financial institutions. So, relatively safe, old. The best part is these are government blessed. So the government has blessed the products, the insurance products that these companies sell. So, starting off, it's a well-diversified portfolio product, super safe, AAA rated, 170 years old, government blessed. So it sounds pretty good so far.
Yeah.
What if the third thing I told you is that insurance companies get special accounting treatment? They are allowed to spread market gains and losses over several years. So what does that do? That really minimizes their volatility. So as you see here, as the market, goes up and down, this insurance product is kind of in between, right? So it's still a little bit, but it's not that volatile, right? So over time, they're able to spread those market gains and losses, so it's less impacted by market fluctuations and new market interest rates coming in. And so for those investment gurus, including you on the call right now, for whole life, standard deviation is around 2%. So, what am I missing right here, right now? So it's well diversified, government blessed, super old, less volatile than the market overall. And the best thing that I haven't even gotten to is it's all tax exempt. So especially for higher net worth individuals, in this changing landscape that we're seeing in front of our eyes, one of their biggest concerns is, how do I minimize my tax liability? So when I mean it's tax exempt, is I pay in my premium with after-tax dollars, but any of that cash value or equity that we were talking about grows tax deferred, and I can borrow, I can lend against that at my own pace, my own rate schedule. And as we said earlier, the most important part is that death benefit pays out tax-free towards my family or beneficiaries. So for high net worth individuals, really wanting to reduce that tax burden, I can pass along all that money, whether that's hundreds of millions, 50 million, I can pass that along to my beneficiaries tax-free. And that's the best way to transfer that wealth down to different generations.
That's outstanding. Can we dive a little bit into the borrowing and lending piece of that?
So as I was saying earlier, on the whole life permanent side, you can build up equity inside of these policies, which is the way they grow at. And it takes a couple of years. This isn't a short term, it's more of a long-term investment vehicle. And when it grows up to a certain portion, I'm able to borrow or lend against that. So say I've put in over the years 100,000 in premiums, and my account value has grown to say 150,000, just to keep it simple. I can pull out up to what I've put into that. So that 100,000, I can pull that all out tax-free. To say I want to pay for my kids' education, a medical emergency, want to buy a new house, I can pull out all that 100,000 tax-free up to my basis, which I put in. That extra amount above my basis is taxed at ordinary income rates, but it's still there to be borrowed against. Or instead of just pulling it out altogether, I can take a loan from that policy. So I can loan out as much as I want. That's at about a 5% loan. But what's nice is there's really no loan schedule that I have to pay that back. Versus if I take a loan from a bank, that may have to be repaid within 10 years, 5 years. What's awesome about that is that I'm essentially my own bank, since it's my own policy.
Absolutely. Yeah.
So I can, pay that back over 20 years if I want. I don't even have to pay that back if I don't want to. And then if I pass away, any outstanding loan is just taken out of my death benefit.
Got it.
What's great is like these policies, a great analogy is like they're a Swiss Army knife because there's so many different uses that they can be used for down the line. And what's nice is I don't have to decide on how I want to use that from day one. And
Mhm.
it really provides that extra optionality into the future.
That sounds great. I mean, one other question for you though, how much equity do you have to have built up in a policy before you could loan again, borrow
Well,
again?
really, there's no amount. So if I wanted to really take a loan from year one, there may not be that much equity in that. But if I needed, say, for a medical emergency, hardship withdrawal, I'm still able to access that.
Hmm.
But what's nice is the longer I let it build up, the more money I've funneled into this policy,
Right.
the more money I'm able to access tax free. Because on the cash value side, as I said earlier, you can borrow, take out as much as you want, up to the amount of basis that I put in.
Hmm. Okay. No, that's outstanding. Now, when that loan is being repaid at a
Yep.
5%,
Yep.
who gets the 5%?
Really, it's just being paid back into the policy.
So
And
the
what,
policy is gaining a 5%
yep.
return.
Yeah. And what's nice
That's
too
awesome.
is what's nice too about these policies is when I'm taking money out, these policies are still growing.
Hmm.
So I can pay back the loan over this policy over 15, 20 years as long as I want.
Hmm.
But even though I've still borrowed from this money, the policy is still growing.
Right.
And at the end of the day, if I choose not to pay back that loan, nothing happens. It just takes out of the death benefit when I pass away.
Yeah. I mean,
And,
it sounds brilliant to me.
and
I mean,
what's great too is usually what we hear is when we explain this the way that I've just shown you,
mhm.
but I've explained that is the best response we hear is this sounds too good to be true. Right. And that's, when we've done a great enough job to explain it, that's what we get because people either, haven't been told this in the past, they didn't know this. And that at the end of the day, the truth is the government has blessed and approved these policies for these large financial institutions, and they've been selling them for close to 200 years. And
That's outstanding. Yeah.
that's why, they've government blessed, government approved, and that's why high net worth individuals are viewing this as an asset class. And so this is really, this is whole life. And the major difference between whole life and variable life
Mhm.
is this, this diversified wheel portfolio on the whole life side. It's more conservative allocation. As I said, the majority is fixed income bonds. And the reason they do that is they have such a long time horizon of claims that have to be paid
Right.
out that they do want to take a more conservative approach.
Right.
Versus on the variable universal life, the policy holder, me, I'm able to allocate my premiums into a variety of different investment options that I choose, that I want to see fit. And usually what we see is they're more allocated to more equity strategies, equity investment options. So they're trying to get a higher return. The only thing is there more risk associated with that.
Right.
And then, so really that's, whole life and variable life, they're pretty similar, just the type of products they're invested in.
Mhm.
And the last one that we want to touch on is universal life. And really that's a hybrid between term insurance and the permanent insurance we were just talking about,
Uh-huh.
where, the policy premiums start off very low in the early years. And then
Mm,
as you get closer into the later years, they really start to skyrocket.
gotcha.
And the way these policies are designed that, they're building equity up over the years. And in the later years, that equity in the cash value is really meant to help support those higher premium payments.
Mhm.
But the
Mhm.
problem with these policies today is, they were issued, say, 20 years ago with interest rates closer to 8 to 10%. And then this lower interest rate environment that we've seen over the last couple of years, in reality, this policy is only earning 4 to 5%. So these policies are really underperforming where there's not enough cash value to help supplement some of those higher premium costs in the later years.
Mhm.
A lot of policy owners are running into problems. And personally, I've run into a couple that have been pretty ugly. We've kind of had to do a restructure of the entire estate plan for these individuals. So that's what I recommend for some of your viewers. If you know someone that owns a UL policy or has a universal life policy that hasn't reviewed it in a couple of years, I strongly recommend, getting that policy out of the basement or attic and taking a closer look just to see where those numbers are on track and to see if something has to be done to fix those.
Great. Now, can you like you can turn your term life into a permanent
Yes.
insurance
Yeah.
policy, and you change your universal to a whole life if you wanted to, or is that what's
You can't really because
okay?
so term insurance you can only transfer to a permanent insurance policy, and
Mhm.
universal life falls under that permanent insurance side with
Okay,
whole life and variable life.
let's see.
So you can't really.
You can't go from one permanent to another permanent. You just have to
No,
start a new policy.
yeah. So what we see, as we were saying earlier, usually what most people do when their term insurance policy runs out of that time frame, usually most people will just buy another term insurance policy, say for another 15, 20 years,
Mhm,
because it's, it's affordable, it fits into everyone's budget, or with these features, you are able to convert a portion or all of that term insurance into a permanent policy
mhm.
that over the long run, you're able to build up equity inside of it that can be used or borrowed for retirement supplement. But at the end of the day, the most important part of insurance is the death benefit, right? That pays out tax free to your beneficiary or families. And that's why term insurance is the best option because it's really finding the right amount of death benefit
Mhm.
for that individual or family.
Now, one of the things I've come to understand too about term, and you can correct me if I'm wrong on this, uh, term insurance is a lot cheaper initially,
Yeah.
but eventually, as you approach your 60s, 70s, 80s, that term policy can cost you as much as a whole life policy. Is that off base, or is that
No, that's exactly true. And the reason they get more expensive as we get older is because it's called mortality charges. Because as
yeah?
we get older, we don't like to admit this, but we get less
It's a
healthier,
fact.
right? More problems, more aches and pains. And,
Mhm,
by underwriting, the insurance company is taking a risk on us. What is the chance that they pass away in that time frame?
mhm,
So as the older we get, the riskier we get, and they have to take on
mhm.
more risk to insure this. So that's why, as we do get older, term insurance policies increase. But as we said earlier, when you lock in a term policy, say for 20, 15 years, that price is fixed for
Mhm.
that time period. And then when I go to reapply for another term insurance policy, it will be more expensive because it's been 20 years, right? Since the
Right.
last time we came to apply for a different insurance policy. So it is going to be more expensive.
Got it. No, and that completely makes sense because it's like, hey, nobody gets out of here alive. I mean, that's
Yeah.
that's one of the guarantees in life, right? That nobody gets out of here alive. So it's yeah, and that's one of the things where we try to protect ourselves and be able to build wealth at the same time. So
Yeah.
in my thinking, like when my term policy is over or when it's approaching expiration, my thinking is to convert over to the variable life. Well, probably whole life because at my age 8 years from now, I won't want to be in the risky category, with the variable. So the whole life, but my daughter has a variable
Yeah.
policy. Now she's only 12, so she already
Yeah.
has one, which it'll be good for her, long term. But for me, it's like, yeah, so I'll probably definitely be looking at switching over to a whole life policy
Yeah. And
at
it,
that
and it can
point.
be a great option, but you just want to make sure, you take the time to go over all the numbers,
Mhm.
make sure it makes sense in your financial budget. But that's the great thing about term is it does allow you to convert a portion or all of that if you choose. And
Right.
it can be, and that's how, higher net worth families, even, younger families are viewing it as an asset class. And like you just said, families are starting to put policies on their children because over such a long time period, you're able to build up equity that can
Right.
be used for your retirement plan, estate plan. It can really be used for a lot of different purposes.
Absolutely. Yeah, that I love it. That's great. Yeah, and I know for me, the thing that makes the whole life policy appealing for me is that the fact that you can borrow from it and lend
Yeah.
out money against it. Because I mean, why would I borrow money from a bank if I can borrow it from myself and just pay it back to myself, and earn interest that way? I'd rather pay the interest to me than pay it to someone else
What's
over
nice, you're, like I said earlier, you're essentially your own bank where you kind of pay it
time.
back on your own terms. It's at your own flexibility. And it just offers a different asset class that you're able to tap into. And the tax exemption portion of it is what makes it so attractive to individuals. And especially we're facing a new estate tax and estate planning landscape here. and it just offers another optionality that you can use in the future.
It's great. Well, look, do you have anything else that you'd like to share? This has been really great information. I think anyone listening to this has just gotten themselves a gem because the information you're providing is highly valuable, especially for people like myself who are interested in building long-term wealth.
Yep.
And yeah, so I think this has been really great information. So I'm really glad we were able to do this. Is there anything else that you would like to add to
No,
what
I just want to thank you for your time, and for individuals that own a life insurance policy, just make sure you review it every now and then, just to make sure the numbers are on track, and just reviewing it to make sure it's kind of additionally where you started off is very important. And if anyone has questions, I'm happy to do free reviews of individuals' life insurance policies.
Well, that's a great lead in. Thank you very much for saying that. And the next thing I wanted to ask you is what's the best way for people to get in touch with you?
So the best way is you can call me on my cell phone. That's probably the quickest way to get a hold of me. And my number is 720-692-4350. Or you can shoot me an email at lukecarter@financialguide.com, and I'm happy to answer any of the questions you may have.
Outstanding. Thank you very much again, Luke. We really appreciate you taking the time to be with us today.
Awesome. Thank you, Eric. I really appreciate the time, and it was a great conversation.
Okay. Until next time, this is Galt.